Over the last 2 decades, China has developed into a global economic superpower. China has outperformed every other country on the planet in terms of economic growth. But what if I told you that China's entire expansion was all a hoax? Cathie Wood, the CEO of ARK Invest, believes this, comparing China's progress to Japan's 30-year economic calamity in the early 1990s. China is currently undergoing the largest housing bubble in history, similar to Japan's GDP, which was fueled by a real estate bubble. In this video, I'll go over how the world is about to wake up to China's impending collapse from top to bottom. But first, if this is your first visit to our Smart Stocks Academy channel, please accept my warmest greetings. Hit the like button, subscribe, and click the notification bell next to it to be the first to know when a new video like this is released. So if you're ready, let's get to the topic. China's economy has developed significantly over the last 20 years, but real estate has accounted for a significant amount of that growth. Property developers have taken out loans to expand their portfolio of properties to hundreds of locations. Modern glass and steel apartments, office buildings, and houses may be seen across China's cities. Speculators began buying residences solely for the aim of increasing their value. After all, from the point of view of Chinese citizens, house costs have been steadily rising for decades. This was due in part to China's tremendous population expansion, but the suspicion went much further. The majority of Chinese citizens could no longer afford a standard house or apartment in cities like Beijing or Shanghai because housing prices continued to rise year after year. The logical move would be to buy a property close to the cities but far enough to avoid paying high prices. And that is just what a large number of citizens did. People began migrating to houses and apartments 10 or 15 miles away, rather than in Chinese cities. Prices began to rise as a result of the increased demand for residences near cities, prompting citizens to move even further away from the cities. Property developers expected the expansion to continue, so they built houses further and further out ahead of time. If you drive an hour or two outside of Beijing or Shanghai these days, you'll notice something odd. There are many modern buildings in excellent condition, but there's one problem. No one lives there. The only reason those places exist is because speculators believe prices will rise, hence the label ghost cities. This is a witness to China's rising real estate bubble, which is a major economic engine. Take a peek at Ordo's new town, China's most famous ghost town. The city was supposed to have a population of 1 million people, but that number has dropped to 300,000 and then 100,000 in 2016. Ordo's new town was only able to fill its empty dwellings after bringing elite schools into the city. These types of vacant units are so common that the total quantity of space available could fit the entire country of Italy. The Chinese real estate market is currently worth more than $50 trillion after 20 years of growth, 2 times the GDP of the United States and nearly 4 times the GDP of China. According to Loomis Sales, an investment management business, real estate accounts for 70% of China's total wealth. It is uncommon in China for residents to save money for decades in order to purchase a single house. Property prices near cities are so high in relation to income that individuals will have no choice but to rely on mortgages to buy shelter even after years of saving. This is exacerbated by the fact that rising housing prices create a fear of missing out, leading to people to take out dangerously high amounts of debt. 4 of the top 10 most expensive cities to buy a home are all in China. This kind of gratitude is concerning, and it won't last indefinitely. We saw similar indicators in the United States during the 2008 recession, and we're seeing them in China now. The real estate boom in China is already showing signs of a significant slowdown. Property developers have done everything they can to extend their real estate portfolios as quickly as possible, because the Chinese home market continues to rise in prices. As with any financial collapse, greed took center stage, and developers were soon saddled with too much debt. Evergrande, the pinnacle Chinese real estate developer, was one of these developers. Evergrande is one of the world's largest real estate developers. It expanded its real estate holdings to over 565 million square meters of developing land by issuing corporate bonds to overseas investors. Evergrande was only able to do so because it took on more than $300 billion in debt. Evergrande grew as a result of its massive access to cash. It was named the most valuable real estate corporation in the world in 2018. As investors realized Evergrande was in serious jeopardy, the bullish sentiment began to turn rapidly. Evergrande was recently classified as in default by credit agencies after the company failed to repay a $260 million interest payment. As a result of this, Evergrande bond values have dropped dramatically in recent months, causing a credit outcry. In reaction to Evergrande's debt crisis, international bondholders are threatening to sue the company. Part of the reason for these difficulties is President Xi Jinping's crackdown on China's real estate market. President Xi is aiming to minimize China's reliance on the real estate sector by limiting real estate speculation. Homes are for living in, not for speculating, according to Xi. The acts of President Xi pose a threat to China's economic stability. Even though Evergrande is a big fish in the water, it is just one of several developers who are defaulting. Real estate developers in China are dropping like flies at the moment. Shimao, a Chinese developer, for example, recently missed a $101 million interest payment. Oceanwide Holdings, another developer, defaulted on a loan of $175 million. In the fourth quarter of 2021, a total of 484 enterprises were overdue on at least 3 commercial payments, according to a recent exchange. This is a mind-boggling sum. However, the crisis is just becoming worse with the passage of time. It's become clear that Chinese real estate isn't the ideal investment right now, and property developers are fully aware of this. In December 2021, contracted sales for the top 100 real estate development enterprise were down by 35%. According to Cathie Wood, this is the first year in over 20 years that development companies have seen a reduction in sales.
Now, one other thing I'd like to focus on here is China. So much is going on in China that, again, the headlines are getting some of this. But within 1 week, a Bloomberg journalist, Sofia Horta Acosta, reported that all of this happened in Greater China this week. I'm going to just read you a few of these to give you a sense of the drama here. Evergrande suspends trading on the stock exchange. And the developer, Evergrande, was ordered, think about this, to demolish 39 illegal buildings because they didn't have the right permits. Can you imagine if that happened in the United States? The 100 largest developers in China reported that their contracted sales were down 35% in December. And for the year as a whole, they fell for the first time, Sophia says, in at least 5 years. I don't think I've ever seen them fall in the last 20 years. So real change. A few of the other developers went bust. Shimao, which was rated investment grade in November, defaulted on a trust product and rocked the credit market. And the central bank withdrew liquidity. A lot of people thought they were going to increase liquidity because they said they would. A China regulator vowed stability after stock market's rocky start, but they haven't done anything about it yet. And very interestingly, the yuan, the RMB, the local currency, after a very strong year, held up. And I think it held up probably helped by the government, supported by the government. It is starting to weaken, quite a telltale sign. And one stock, Hurong, which had been had not traded since last March, opened this week and dropped 50%.
Even the Federal Reserve has taken notice of China's housing bubble, believing that a recession in China's real estate market may eventually harm the US economy. Stresses in China's real estate sector might pressure the financial system, with probable spillovers to the United States, the Fed stated, citing China's government and local debt as a big issue to back up this assertion. Many economists believe that China's rapid economic growth is a sign of affluence. However, not only in real estate, but throughout China's economy, a large amount of that growth was powered by a massive debt bubble. Over the last 2 decades, China's household debt has risen significantly in relation to both income and GDP. Household debt is increasing at a faster rate than GDP. True, China's GDP has been increasing at breakneck speeds, but China's debt balance has been growing even faster. China's overall debt as proportion of GDP is approaching that of industrialized countries, owing to the severity of the debt crisis. Imagine an economic behemoth like China having nearly the same debt to GDP ratio as industrialized countries. Overextending oneself in this way is certain to have bad results. The Feds also mentioned overvalued real estate valuations and how the Chinese Communist Party's crackdowns could bring those valuations crashing down. This statement was made in regard to the Chinese government's 3 red lines policy for the property sector. 3 red lines defined the maximum amount of debt that real estate developers could take out. A liability to asset ratio of less than 70%, a net debt to equity ratio of less than 100, and a cash to short-term debt ratio of 1 are the 3 conditions. Companies who have achieved these requirements will be authorized to increase their debt levels by 5% each year for each red line they meet. It is reasonable to create such a policy, but the government should have done so many years ago. Cathie Wood compares the CCP's actions to playing with fire because their new policies have the potential to burn down the entire property sector. It will be tough to pull the developers back to the ground floor now that they are overextended. At least one red line has been breached by 2/3 of the top 30 Chinese developers. The problem with these 3 lines is that property developers can't just reduce their responsibilities with a flick of a wrist. And the only option to stay within the limits is to sell houses, which is precisely what many developers are doing right now. Evergrande and Kaisa Group Holdings are frantically scrambling to sell their properties. Evergrande is attempting to sell Evergrande Tower, which houses the company's headquarters in Hong Kong. That property, however, is yet to be sold. Kaisa Group Holdings has put 18 of its projects on the market, covering a total of 4.7 million square feet. Kaisa, like Evergrande, has yet to sell any of these projects. A problem with all of these properties going on the market is that there aren't enough buyers. This is due to the fact that all other real estate developers are attempting to achieve the 3 red line requirements as well. If there are no purchasers for all of the property on the market, Evergrande and Kaisa will have no choice but to cut their prices. And if those prices are continually dropped, the market will eventually collapse. Evergrande demonstrated this when it announced a plan to offer a 30% discount on all homes in order to earn cash. Even while a 30% decline is significant, it is insufficient to attract buyers. Evergrande's properties are not just selling quickly enough to cover the company's loan interest payments. This will slow China's previously rapid GDP growth, which economists have admired for decades. The development of real estate accounts for 29% of China's overall economic output. Consider what will happen to the economy if this sector fails. According to the Federal Reserve, China's impending downturn will affect individuals all across the world, not only Chinese nationals. China's economic slowdown, according to the Feds, could strain global financial markets through deterioration of risk sentiment, pose risks to global economic growth, and affect the United States. In other words, if the Chinese real estate market collapsed, the entire global economy would be harmed. China is practically responsible for all the goods produced in the globe. China has nearly accounted for 28% of global industrial production in 2019. You may believe that China is too big to fail, but this isn't the first time we've seen an economic slump of this magnitude. Despite the fact that the crisis occurred many decades ago, Japan's 1989 real estate meltdown is extremely comparable to the current situation in China. Back in the 1980s, Japan was the gold standard for developing economies. Economists predicted that Japan would soon overtake the United States as the world's most powerful nation. According to the news report, Japan's theoretical land values was 4 times higher than the total land value of the United States. Japan's fast-growing real GDP, which expanded at an average rate of 3.89% annually in the 1980s, was envied by other countries throughout the world. Japan was in a massive debt crisis after decades of booming economic expansion. Japan's firms borrowed massive sums of money after the Ministry of Finance supported corporate borrowing, similar to what is happening in China. Low interest rates, deregulation, and internal stimulus were also advocated by the Finance Ministry, which raised the money supply by 8 to 10% each year. Prices, like Japan's GDP, have been steadily rising. But despite its rapid rise up in the rankings, Japan's economy collapsed even faster. The Japanese stock market has fallen over 60% to 15,900 by 1992. The Nikkei index fell another 45% over the next 2 decades, on top of the previous 60% collapse. Because equity prices did not recover for decades, this crash is known as the lost decades. China, according to Cathie Wood, is in a similar scenario. China's real estate prices have reached new highs, fueled by the country's mounting debt issue. China's imminent crash will have massive deflationary consequences. More precisely, China's faltering economy will send commodities down to new lows. An impending crash might have far-reaching consequences. Commodities haven't crashed much yet, and Cathie is perplexed as a result. Consumer confidence is usually associated with decreased commodity prices, but consumer confidence is still high, which could be misled by food prices.
Now, when China catches a cold, commodities usually catch pneumonia. And we're seeing this in a few commodities, iron ore prices and so forth, but it isn't quite clear-cut yet. And I was saying to our team this morning, how could this be happening and the economy not be falling apart and the consumer not getting restless there? Well, the consumer savings is 75% in real estate. But what I learned this morning, and it does make sense, one of our analysts, our newest genomics analyst, Pierce, worked in his lab as he was getting his PhD at Texas A&M with other Chinese students. In fact, he only worked with Chinese students. And he learned that a greeting in China, the equivalent of a hello, is basically, I hope you have enough to eat. And so pork prices and rice prices are critically important. And what do we see happening there? Pork prices are down, depending on the measure, 33 to 50%. Rice prices are fairly flat. And apparently that keeps the consumer happy. Now, I don't know. I think this property debacle is quite something, so we shall see.
Property values are already starting to plummet as I write this. In November, Chinese property sales declined by more than 16% year-on-year, while new home prices fell by 0.3% month-on-month. A 0.3% month-over-month drop may not seem significant, but when annualized, it amounts to a 3.6% drop. Housing prices in China have slowed to levels not seen since the country's economic recession in 2015. Cathie stated in ARK Invest's quarterly report how she believes China's GDP will stall significantly in the next 3 to 6 months. If we are correct, the market is likely to focus more on the likelihood of recession in the US, the substantial slowdown in the Chinese and emerging market economies, and potentially an unexpected decline in inflation over the next 3 to 6 months, Cathie added. Some commodity prices have already turned red. Iron prices have dropped by 35%, possibly as a result of China's real estate upheaval, while the Baltic Freight Dry Index has plunged more than 40%. DRAM prices have dropped 25%, and US timber prices have dropped by 33%. Even the WTI oil price, which had been a major exception until lately, has dropped by 12%. The Chinese Communist Party has acknowledged that the Chinese economy is deteriorating and has taken steps to prevent a disaster. China's central bank has announced a reduction in interest rates, which is expected to help the economy. This is in direct opposition to Federal Reserve Chairman Jerome Powell's desire to hike rates as quickly as possible. China's real estate industry is in serious difficulty, and it is only going to get worse as the time goes on. Due to credit tightening and restrictive values, the S&P rating agency predicts a 10% drop in countrywide residential sales in 2022. No matter where you are watching this video from, the deterioration will have an impact on you in some way. As a result, please share your thoughts about China in the comment section below. Do you happen to agree with Cathie Wood's point of view? And with that, the video for today comes to a close. To express your love and support for the video, don't forget to hit the like button below if you haven't already. Also, subscribe to the channel by clicking the subscribe button below and clicking the notification bell next to it to be the first to know when a new video like this is released. Thank you for taking the time to watch, and we hope you enjoyed yourself. Looking forward to seeing you again soon.